Hi, everybody. It's Maureen Lein, your local lender with Rate, here with this week's Mortgage Minute. Today is Wednesday, August 12th, around 9:30 a.m. And finally, there is some encouraging news for mortgage interest rates this week. So for the last several weeks, we've been talking about how mortgage rates were being influenced by geopolitical tensions, the oil prices, inflation, and the labor market. And now we're getting some better economic news. Inflation is starting to cool. The labor market is weakening and wage growth is slowing. This morning's consumer price index, that showed headline inflation is currently at 3.4% year over year, which is down from 3.5%, while core inflation fell from 2.6% to 2.5%. And last Friday's job report, that was also weak, showing the economy actually lost 23,000 jobs in July, and the May and June numbers were revised lower by a combined 103,000 jobs. Now, all of these numbers give the Federal Reserve less reason to keep rates higher for longer. But here's where I want to connect this to what we've been talking about in previous mortgage minutes. We're now getting back to the bond market influencing mortgage rates. So think about it this way. The economic data gives the bond market the information. The bond market decides how investors react to that information, and that reaction ultimately influences mortgage rates. So right now, the economic ingredients are becoming more favorable for lower mortgage rates, but mortgage bonds, they are still having some technical resistance to overcome, and that's why I'm not shouting from the roofs, hey, mortgage rates are coming down. I am saying, though, that the news is getting better, and now we just have to wait for the bond market to confirm it. And we already are starting to see a little bit of that improvement show up in the mortgage market. The average mortgage rate, that fell from 6.81% to 6.77%. Purchase applications, they increased 3%, and refinance applications increased 5% week over week. Existing home sales, they remain pretty stable and are up 2.4% year to date. Inventory did, in fact, fall nearly 2% last month, but this just continues to provide support for our home values. The July median home value was $434,100, which is up 2% from last year. Now, bottom line, everybody, is we are seeing the cooling inflation. We're seeing softer labor market and improving mortgage application activity. And those are still encouraging signs, but now we're watching to see whether the bond market responds the way that we would expect it to. So that is it for this week's Mortgage Minute. If you're thinking about buying, selling, or have just mortgage questions, please reach out to me. And if you don't mind liking and sharing this, that would be great. And then I will see you all next week.